Okay, so again, very welcome everybody. This is part 2 of our trading psychology webinar. So part 1 yesterday was really awesome. We talked more about kind of the trading psychology, right? About how to, as I put it, keep your mind right when the market is wrong, which again is such an ironic statement, but I love it so much. And we had some great discussions. We talked about some great things to just kind of get you started. If you have not seen the webinar yesterday, I've sent out the recording and so on, and hopefully everybody received that. Does everybody know where to find the webinar recording from yesterday, and or did everybody receive the email with the webinar recording? I want to make sure that that came through for you all. Because it was a great webinar. We had a good time. Right now, you can go over here to dtfx.co/trading success, and this is where you can also watch the webinar. And I wanted to just kind of show everybody really quick here. You can also download the presentation right here, right below the video. So just to make sure everybody saw that. A couple people were asking about that. Can we download the PowerPoint? Yes, you sure the heck can. So it's all right there. Excuse me. And it's good stuff. Good stuff. Okay, so let's get down to what we're going to cover today. We have a lot to cover. I want it to be a fairly open discussion, guys, so don't hesitate to ask questions, make comments. It might take me a minute to get back to some of your questions, but I won't forget anybody, and I'll make sure we do that. And so let's get going here. So for everybody that's joining us today for the first time, again, the webinar recording will be super important to watch from yesterday because that gives us the foundation of what this is all about, right? What we're trying to do, and we've got to make sure that the mental game is strong before we get into, to anything else, right? We need to kind of know what we're up against. I once heard that, that the best kind of learning is just figuring out what questions to ask. And that is absolutely the truth. And so in the webinar yesterday, we really talk about what are those questions we need to ask? What do we need to know, before we get started, as we're trading, getting into our career? We have a lot of people, I have a lot of people, in the group but I get a lot of emails from people, and I have a lot of communication with people that, have been trading for 1 week or for 1 decade, and some are hugely profitable and some are losing money like crazy, and everything in the middle, right? And so this is where we need to make sure we understand all the important elements of trading psychology and just kind of how to put together a bit of a plan and a strategy, and then the rest will be so much easier. So that's what we're trying to do here today and yesterday. Okay, so let's talk a little bit about this. Today we're going to cover specifically how to win at trading. So we talked about how to win at the mental game yesterday. Now it's time to actually start getting some trading going and doing it right. And so it's going to be awesome stuff. So stay with us for the whole time. I will dig through this stuff quickly and efficiently, but like I said, I want to make sure that everybody has a chance to ask questions and feels comfortable to ask questions, so please don't hesitate. Just type them right in. I get a lot of people telling me, I'm not a chat room kind of guy. Well, be a chat room kind of person today. Type in your questions, type in your comments. We all want to hear it. Okay, so once again, this is me and the family. Just always like to put a face to the name of everything. So this is me and my lovely family. I'm pretty lucky to have them. They're fantastic. Again, I'm Jared with Day Traders FX. A little over 15 years of trading experience, a little over 10 years of training and consulting and running trade groups. And it's been a wonderful experience the whole dang time. Really enjoyed it. So always happy to speak with traders. Really love to talk about trading, all things trading. It's really, really, really good stuff. So it's awesome to connect with people from all around the world. In my trade group, I swear we have one person from every time zone on the planet, at least one. So it's really cool. It's sometimes challenging to keep up with everybody and middle of the night, middle of the day, but we do a pretty good job. and really, really good to connect with people from everywhere. Every time I take a crazy trip with my family, and because I'm a trader, we can, I can do that, right? I just need internet. And so wherever I have been, we've been to, Central America and South America and all through Europe and Asia. Every country I go to, just every single country I go to, I usually send out some emails, and I meet up with people that are in the trade group that maybe I've never met before. And it's really fun. So I love having a trade group. I love chatting with you guys, and I love talking about trading. It's a great, great thing. And speaking of trading psychology, trading attracts interesting people, right? Interesting in a good way, that is. Because, you guys are all a good group of people. And the one main characteristic, besides the fact that, everybody that I talk to for the most part is nice and polite and kind and friendly and just overall good people. But besides that, trading attracts people that want a little bit more out of life. And it's a really inspiring group to be with, to be honest. People in the trade group are people that are trying to do more and be more and, and have more freedom in life and do things. So it's really a good group of people to hang out with. On a total, opposite side of the coin, I have one of my good friends is in law enforcement, and he works in the, prison system, I guess you could say. And he finally had to quit doing that because he said, I didn't know who was worse that I was working with, the prisoners or the guards. Said they were just all tough people that I just had a hard time showing up to and interacting with on a daily basis. And I thought, man, I got just the exact opposite. I have such a great group of people that I get to interact with on a daily basis. So thank you guys for being awesome. You guys are really great. Okay, let's get down to it. We're going to talk about the nitty-gritty, as we say. So this is what is required to beat the market. Now I've got a lot of slides today, but I don't want to use them to death. I want to talk from the charts because that's always the best way to do it. I want to show real results. I want to show real strategies. I want to show just real stuff, right? But we do need to make sure that we've got some sort of format here so we can keep up with, so that we can keep track of everything that we're talking about. Mostly for me because I like to go a little bit of all over the place. So I want to just keep on track here. So these are kind of the things that we've discussed and will discuss. Yesterday we talked about having strong psychology, right? Being able to understand the mental elements of what it takes to be consistent and successful at trading. Two very, very important things. We also talked about the fact that we need a solid strategy, and we discussed that there would be more details about that today, which there will be, and I'm excited to talk about it. And the thing that we really need to have as a core element of all of this is real results, right? There's a lot of optimism out there. Yesterday we talked about the three kinds of traders, right? We talked about the experimenter and the gambler, and the full-time trading candidate, and real results are so important. We can think and feel all we want about whatever we want, but at the end of the day, it's the numbers, and we need to keep an eye on those. And sometimes they're hard to look at, but we need to know what those real results are. And we're going to talk more about that. Okie dokie. So we're going to talk about a strong strategy today, and I want you guys to know that that strategy is not hope. So, I would say that I'm somewhat of a religious person. I believe in a higher power. I like the idea of hope. I think that's great. That's excellent, right? It doesn't work in trading, right? We can't call on our higher power to make our trades work. It's just not how it goes, unfortunately. Trust me, I've tried it. But what we want to make sure of is that we are not blindly going into something that will beat us up, right? And again, yesterday we talked about the fact that 75% of traders around the world, as according to brokers' reports, are losing money trading Forex. A super sad thing. And a huge, huge, huge part of that is because people are going into trading with nothing more than hope. Hope and some determination and, you know, let's see if we can do this kind of an attitude. And that just doesn't work. I've been trading too long to rely on anything other than hard, cold numbers and strategies and just the facts, right? So let's talk a little bit about these elements, you know, individual parts of these elements here. So the three basics of our strategy, and we talked, you know, a bit about this yesterday. Strategy, trade size, and patience, right? We've got to have those, and that is kind of the foundation and the starting point of actually being able to be trading successfully. If we don't have, if we're missing any one of these things here, it won't work. It's absolutely a three-legged stool, and it will fall to the ground if any of these things are missing. So we've got to make sure that you know, I want to really imprint in your guys' minds and brains, which is why we're talking about it again here, these three elements. They're musts of trading. Okay, so let's get right down to it. A strategy is very important, right? And you know, I kind of use the word strategy and maybe even trade plan somewhat interchangeably, right? But they're, you know, I'm referring to the same thing here. So in our strategy, we need to know a couple of things. This is kind of the basis of our trade criteria, right? We need to know a few important details. Number one, where is the market headed? These are targets, right? What is the market trying to hit? And do we have, you know, do we have reasonable targets that we've used and that we know? And I'm going to show you what my targets are and what I like to use. Where has the market been? This is our trend, right? Trends are only up to the second, right? Targets are that future trend. They're that leading indicator. A trend is only telling us what has happened, right? It doesn't tell us what will happen. It's telling us what has happened. Targets have a more likelihood of telling us what will happen. So that is super important. Targets for me, and those of you that are in my live trade groups, you know that targets are everything. They're just absolutely everything. And we need to know where the market will decide. Where is the market going to make a decision of what comes next? And these are levels. So we need targets, trends, and levels, right? Those are kind of the basis of any strategy and any foundation. And we're gonna dive right into the charts on this one, and talk a little bit about what this is and how it goes. So hopefully everybody's ready. Let's get right down to it here. Give me 1 second. I'm opening up something on this end. Excuse me. So let's have a peek here at my charts. Okay, there we go. There we go. All right. Okay. Sorry, guys. Just getting down to some stuff here. Okay. So we're going to talk about you know, all these details, right? And I'm going to show you exactly how I manage this stuff within my own trade group, but really how we kind of you know, tackle this approach. So our strategy of trends and targets and levels and so on, let's go down to something like this, right? I'm always, now, whether or not you are a short-term trader or a long-term trader or an anything trader, if you're a scalper or you're a swing trader, we must know the big picture, right? And that means you've got to become friendly with the weekly charts and the daily charts and the 4-hour charts and the 1-hour charts. And then if your ultimate, trading time frame is the 5-minute chart or the 1-minute chart or the 15-minute chart or whatever, fine, great, wonderful, no problem. But we've got to know what this big picture is, right? We have got to know where is the market most vulnerable to change, where is it most likely to continue to, all of this stuff. And we can only know that from the big picture. So that's super important. So that's thing number one. Now, in this strategy side of things, remember, just to kind of put on here, I want to make sure that we can keep in track, in line what we're discussing here. Remember, we're trying to find targets, we're trying to find trend, and we're trying to find levels. These are so important, and if we can identify what these are, we can start to have a good idea of where the market's headed. One thing that I get asked on a regular basis is, will the market go here? Will the euro dollar go to this? Will the euro dollar go to that? And I always have to tell people, you could be the best trader in the world and you can't predict the future any better than a witch doctor or a whatever, a palm reader can, right? And if there's any palm readers in here and you actually can predict the future, please send me a private message. But we are in the game of lining up probabilities, right? So we cannot predict the future because no human being can, but we can line up probabilities in such a way that we are as darn close to predicting the future as possible. I like to kind of compare it to, when we really understand a good solid strategy in trading, it's kind of like planning your day out, right? You might know that that your alarm clock is going to go off at 6 a.m., right? And you're probably going to get up, and you might take a shower and get dressed, and you might do a few things, and then go to work from 8 till 5, right? And then you're going to come home and be with the family and have dinner and go to bed, right? And there's a pretty high likelihood that if that is something similar to your schedule, that's going to happen on a Monday and probably a Tuesday and a Wednesday and a Thursday and so on, right? And so the market can become as predictable as that, right? We always say, a predictable schedule can be boring. Well, boring and predictable in the market means money. It means a lot of money, and that's what we want, right? And so as soon as we start to understand the elements of the market, things can become that predictable. Now, in your daily schedule, yeah, you might get a phone call saying the power line is down in your backyard, and you got to call the power company and so on, right? And so that could be a variable that you weren't planning on, but it doesn't derail the day, right? Or, heaven forbid, you might get a speeding ticket on the way to work. That doesn't derail the day. It might slow you down, it might get you a little frustrated, but everything can still continue on semi as planned. The market is the exact same way. But if we don't know where that, so to speak, schedule or where that kind of plan can be derived from, then it all seems very random, and it all seems very unexpected, and it all seems rigged and impossible to work with, right? And that could not be any more further from the truth than the fact that everything is completely random all the time. Yes, of course, there's randomness, but we can learn to expect certain things just like we can in our day-to-day schedule. We can learn to expect those certain things in trading. And so we're lining up these probabilities. We become semi-fortune tellers by being able to do this, and the market will behave fairly well. There's going to be flash crashes in the market, and there's going to be surprise news announcements and so on. But the way that we deal with those is by having our strategy. So let's have a little bit of a look at some of these elements right here, right? Targets, trends, levels. Okay, so just by a show of who all is present here, and give me a quick look. What would you say the trend is on the Australian dollar, US dollar on this long-term weekly chart. This high right here is 2011, right? 2011. This high right here is, you know, January 2018. So, you know, we're talking big charts here. What is the trend of this chart? Can anyone tell me? Anybody? Who can see? Oh, Paul. Good job, Paul. It is a downtrend. Everybody agree with that? You guys agree that this is a downtrend, a downtrending movement here? Anyone disagree with that? So this is, yeah, okay, good, Bob. Yep, down and has slowed. Yep, down. Yep, okay, Jim, excellent, good. So that basically means that this trend right here is coming down, right? It's making lower highs and lower highs and lower highs and lower highs and so on, right? Bounces, comes back up, you know, nice little double top right here. Sometimes my straight lines are not quite so straight. Ooh, boy, just terrible. So we've got this downtrend, right? So remember, this right here is telling us where the market has been, right? Where the market has been. But will it tell us where the market is going to go, or is this a little bit of a lagging indicator? Now, trends, of course, are super important, right? Because markets are big and they have characteristics, right? And they have a lot of momentum. And when we have a big, you know, thing like the currency market, you know, like a currency itself, downtrends are, or excuse me, trends are kind of like freight trains, right? Once they get going, they can go for a while, but eventually they can run out of momentum. And so our goal is to try to figure out, you know, okay, we have this trend. Will this trend continue, or will this trend run out and stall and be done, right? Those are kind of the things that we're looking for. So that is going to be kind of our first look, right? We need to see, are we trading something with a trend? You know, you're going to find things that have no trend at all. They're actually very sideways, and some things have big long-term trends and so on. But part of identifying these trends and kind of the characteristics is knowing a little bit from currency pair to currency pair how things behave, right? For example, yen pairs, Japanese yen pairs. For those of you that might trade those, you'll notice that those tend to trend a lot more. Those can just go a lot more uncharacteristically long than other currency pairs can. They can just trend for years and years, basically. But they also can go very, very sideways for long periods of time. And that's because there's characteristics of the Japanese yen that cause that to happen. The Japanese yen, for example, is a safe haven currency. Things happen unstably in Asia and oftentimes in the US, and we see the Japanese yen kind of take the pressure off by becoming a bit of a safe haven, right? People start to pour their money in the Japanese yen because they're uncertain about what else is going on, you know, in that region. And so there's that kind of a characteristic. The US dollar has a similar characteristic. It's kind of a safe haven currency for this part of the world, right? When things get kind of scary in the US stock market and in certain other spots, the US dollar can kind of start to go really sideways. The Swiss franc has a similar kind of characteristic as well. So these currency pairs that kind of do that, right, that become safe havens can have big long trends, and they can have big long periods of sideways nothingness. So it's important to know that, and you know, and there's some studying and reading you can do, and you can, you know, Google that kind of stuff. And of course, you know, I talk about that a lot in my trade group and so on. Then we have things like, you know, Australian dollar, New Zealand dollar, Canadian dollar. These are typically kind of the commodity type pairs that are a little less unruly, right? We don't quite have the crazy, ridiculous long-term trends. Remember, we're looking at, right here, we're looking at almost 10 years worth of movement. So it might look like, hey, this is a big trending chart, but this is 10 years worth of movement. And so, you know, we kind of just need to know the characteristics of the various currency pairs. And that's super duper importante. So that's something that we want to make sure of as well. George, doesn't the 200 EMA give us an indication of movement direction under, down, under? Yep, yep. So the 200 EMA, that's a great indicator. We're going to talk about that for sure. Absolutely. Good question. Good comment. So here's our trend, and remember our levels, right? So this Australian dollar from back here in 2011 took a big dive for a couple of years. But remember, these big dives were several months down, few months up, several months down, few months up. There's a lot of consolidation here. Several months down, few months up, few months down, few months up. Then we had just this move right here was August 2014, and it went to January. This went for a couple of months. It really kind of dropped, started making some pullbacks, a little bit more, and then it spent months and months, well actually a couple of years, probably 2015 to 2018. So then it spent a couple of years going up, right? And then it's been going down for about a year. So just kind of getting a feel for these movements is super important. So the trend will give us that idea. Now, trend is part of the picture, right? We say, okay, there's downward pressure on the Australian dollar. Will there continue to be downward pressure on the Australian dollar? And this is where these two guys come into play. Oops, hold on, it's the wrong button there. This is where targets and levels come in, right? So now we have this trend, and the Australian dollar came down and it hit this level. We don't really know why. You can definitely look at things like Fibonacci and some harmonic patterns and so on. You can say, well, we definitely expected the Aussie dollar to turn around at 68.50 down here after this, multi-year run down. I look at that and I think, yeah, who knows why that would have flipped around over there, It just did. But the fact that it did turn around right here now gives us an important level to watch, right? There's an important level. And so as this turns around, again, it turns around and we go, well, okay, that's interesting. There's kind of a double bottom right there. We have a little bump and a little bump. It's a little bit of a double bottom there, give or take a couple of pips. So then this thing starts to turn around and starts to make its move, right? And it starts working its way up and working its way up. And then we end up with this little double top up here. We're starting to see these levels really, really line up. So now we have this little, double bottom area running through here, push through it just a little bit. We've got this little double top running up through here. So now we're starting to get kind of a little bit of a picture of where this stuff might be headed. So now, as this has kind of hit this level, run up, turned around, given us a double top, and so far stayed with this big long-term trend, this is coming back down. And so now this pre-existing level over here becomes a major point of interest over here, right? Does anybody know what this is specifically called right here? Anybody? It's just a real simple little pattern here. Called a double bottom, right? Everyone good with double bottoms? And so the fact that this level was created over here tells us that this level is going to be significant. So this now, as we talked about levels, this now creates for us a decision point. Now, the way that we look at decision points on charts is, okay, this trend has been going. Will this trend continue? That's the big thing that we want to know. It's been going, and will it continue? So, it is interesting, by the way, George. Interesting about the Australian elections. So everything's staying kind of status quo there. Yeah, we've got Aussie elections this weekend. So you guys have Aussie elections. So it sounds like it's staying put there. So now, as we identify this level, then we start to look for what is going to be the decision point, right? What's going to happen at the decision point? Excuse me, Jim. Absolutely, market imbalance, and those are our targets, right? So we have a trend telling us this is going down. We have a strong support level, i.e. a double bottom, telling us that the market needs to make a decision. And now we're going to use targets to help us determine where the market is going to head. So what I'm going to look at right here is I'm going to say, okay, are there interesting targets down below? Is there reasons for this Australian dollar to continue lower? Now we can look over here and we can say, well, we've got a big support level, and it's at a round number, right? 6,000. So that's something we might want to look at. But what I use for targets is something more than just support or resistance. I use support or resistance for targets, but I use things called pivot points. I use things called market imbalances. I use indicators called the 200 moving average. These are all things that I use for targets to help me determine where the market might be turning. And we're going to talk all about that. But it's all about trying to find where are more targets setting up, right? In your own strategy, you might say, well, I have found that X, Y, and Z are very reliable targets. And again, we can only know that if we go back and we look at the numbers and we can say, yes, time and time again, the market has hit this level. It's reacted to these targets. And so I know that they're valid and I know that they're good, right? So you can't just, I'm here to have a little bit of a reality dose here. And this is part of the real results. We can't just say, this is something I like. You can say that. You definitely can say that. But it's also got to be something that works, right? A lot of people say, I just love Fibonacci. And I like Fibonacci too. I'm sure he was a nice guy. But apart from loving Fibonacci, Fibonacci is a great indicator. It's a great tool. If you're not using it correctly, or if you find that in your strategy it just doesn't really work, then Fibonacci is a waste of your time, right? If you love harmonics, if you love Elliott wave, any of that stuff, those can all work in their own field and in their own right. But if they're not working for you, then you either need to adjust your strategy or you need to stop using it, right? So it's all about real results. That's all we care about when it comes to trading, is what is actually working and what is not working. That's it. Nothing else matters. So we're looking and we're saying, okay, I like targets, and at this point, the only interesting target I can see down below is just an existing support level, right? Just an existing level of support, which is down there at a round number, 6,000. Great. That's all I can see. But as we go to smaller time frames here on something like the Aussie dollar, the targets that I know work, and people that are in my trade group have seen them work over and over and over and over again. These are targets that produce these results right here, right? 350 pips, 400 pips. One of my favorite trades right there, 10 pips. Okay, not my favorite trade. But these are things that produce actual real results. 145, 145. That's not a typo. Those are two. Little pain in agony right there, right? These things produce real, consistent, steady results, right? And so I can look at this and I can say, all right, the targets that I use, there's actually more of them up here than there are down here, right? So I've got a lot of targets up above, and I've got few targets down below, or few, if any, targets down below, right? So there's a downtrend. What has happened? There is a strong level, a multi-year low / double bottom decision point. Now the market has to decide, what am I going to do? My system would tell me that the market is more likely to head up than to head down, right? Because this trend has been happening, yes, but we have a massive decision point, right? The larger the time frame, and this is why we've got to know the big picture, guys. We've got to know that big picture. So many people say, I don't even know what to look for on the weekly chart or the daily chart, and it's a good question. It's a good, it's a good thought, right? And so at this point, we have to say, all right, what is the big picture? What is the likelihood of what we want to have happen? What is the likelihood of that happening? Exactly, George. What are the probabilities here? Does anybody feel like, let's just say now, of course, members of my trade group, you know that we have a trade on this currency pair, and I can show you this on a million currency pairs, but people that don't know the trade that we have running here, what do you think would be the better thing to do? Do we continue trading in this trend, or do we continue, or do we look for this decision point to hold and for a new direction to develop? I'm just curious people's thoughts, just curious what people think as you look at a chart like this. Do we stay with the trend? Do we kind of go the other direction? Think about that. You can answer if you want, you don't have to, but that's that's something that we have to always think about as traders, right? What is going to happen here? And why do I think whatever I think is going to happen? Why do I think that? What is the thought process? And this is where we come up with, again, this kind of three-step strategy here. What has happened, what is currently happening, which is we're at a decision point, making a decision. What will happen, which is, will the market move towards targets? And for those of you that are in the trade group, and those of you that are not in my trade group, the market will always move towards targets, right? And it's just, have we been able to identify what are the valuable high probability targets? It's awesome. It's good stuff. George, I would have gone south, but after a few months with you, my philosophy has changed, and I am now so much more comfortable being a contrarian trader. Good, excellent. Yeah, and contrarian trading is, not necessarily, we're going against the past, right? And we're finding, the slightly against the trend kind of movements. And these are the ones that really produce, the profits and the gains and so on. And I'm not here trying to tell anyone, don't be a trend trader, be a reversal trader, whatever. I'm trying to show everybody how to be, how to identify these setups and how to start finding trades that are going to work. I once heard in my veriest early time of trading, I was probably 3 months into trading, and there was somebody that I was kind of working with a little bit, and he was a pretty good trader, and he seemed to kind of know what was going on fairly well. And he said, if you can see the trade happening, it's probably too late, right? And that is exactly this. We can see this thing happening. It's probably too late to get that trend. Well, here's another year plus of trend, right? I can see that happening. It's probably too late to take that trade, right? This kind of strategy that I'm talking about is we get in with the confidence that our system is going to deliver, and we get in before the movement is totally visible, right? And that's what we want to be in. Remember, in every kind of in every kind of trading, there's 3 movements, right? There's the first movement that the smartest, best money gets into. There's the middle movement that kind of, the middle chunk gets into, the people that are kind of trying to follow the big movements, they're getting into that, the second group. And then there's the last movement where the majority gets in, right? They're getting in, not even in the first part, not even in the second part, but they're getting into the last part of the movement, and that's so common in trading. And what we want to do is we want to get in that first part. We absolutely want to get in that first part of the movement, because that's how we can find these trades, right? That's how we find 225 pip trades, and that's how we find 145 pip trades and 400 pip trades and 350 pip trades and all that stuff, right? It's gotta, we have to get in before the movement is visible. This is, again, my strategy, and so I'm just trying to tell you guys a little bit of that. Okay, let's see here. George, okay, Norbert, 2007 was a big financial crisis. Today is more stable, so reverse. Yeah, so Norbert, yeah, 2007 was a big kind of crazy move, but in 2007, I saw the signs on the charts and I made just an absolute crazy ton of money. So, so the strategy worked in that. I did pretty darn well. People were saying, oh, you're a trader. It's 2007, 2008, 2009. You're a trader. I'm so sorry. I hope things are okay. And I was like, sorry, I made 10 times what I normally make in a year of trading in 2008. Like, it was amazing. So, but it's because my strategy was able to handle crises and trends and all kinds of stuff, right? It's not that I always know what the market's doing, but I can at least, deal with what is happening, right? And usually come out okay. What about taking into account market news, financial strength, and weakness? Yes, good. Include fundamentals to predict reversals. Yep, Dwayne, absolutely. Unless you're the Japanese yen, it seems to go forever in a trend. That's true, George. That's true. So, so Paul and Norbert a little bit on this comment as well, and Dwayne. Interestingly, you know, and I will say I'm a big technical analysis guy, and I spent a lot of years in my trading career being a news guy, a fundamental analysis kind of a guy, and I just found that that was just not happening for me, right, personally. And so the thing that I interestingly started seeing and noticing would line up is good solid technical analysis would kind of preempt the news, right? As we come to a major level. I mean, it's interesting right here that the Australian dollar is coming down to a multi-year low, and it's actually sitting almost at after years of downtrend and after a specific year plus of just steady downward movement, the Australian dollar is sitting at a multi-year double bottom and a 10-year low level that it's interesting that the election news is right now, right? So we're going to get some sort of reaction from the fundamentals at this technical level. And so it's really interesting stuff. But I'm 100% not that guy that says, I don't ever pay attention to the news and I don't look at it at all, because I think that's also not good. We want to know, you know, when news is coming, when news is hitting. Election news is huge. Interest rate news is huge. Job numbers are huge. So we want to make sure that we know that stuff. So we keep that in mind, but we're always trying to find trends, levels, and targets. So as we talked about this Australian dollar coming down to this level right here, here's some stuff that I'm looking at as I'm kind of looking at this big picture, right? Let's go down to this time frame for a moment, and you can see here are pivot points, right? Pivot points, all a pivot point represents is simply, is the market in balance for today, for this week, for this month, yes or no? That's all, yes or no. Because remember, markets are, even as erratic and crazy as they can seem, they are fairly efficient, right? And an efficient market will not run up forever, and it will not run down forever. That cannot happen, because everything would crash and the whole entire financial system would cease to exist, right? So we know that that is not even a consideration. And if that does happen, if markets really do have some sort of massive crash and they never come back, our trade loss that we take from that is going to be the smallest part of our problems, right? Probably somebody trying to loot our house or the neighbor's house is going to be a bigger issue at that point. So markets are efficient and they react to balance, and balance is represented in pivot points, right? Pivot points tell us what is the average movement of yesterday, what's the average movement of today, what's the average movement of the week, the month, and so on. And it helps us to identify where things are becoming too stretched one direction or another. So I use pivot points we start to get them lining up on one side or the other, kind of like this Australian dollar has. And you can see where I've got all these circles here. These are pivot points, right? I'm just using the Australian dollar because it's an easy example. There's actually a ton of these that are happening, but the Australian dollar, here's a daily pivot point. There's a daily pivot point. Circled means that this has not been touched. The market has not rebalanced with this level, because what we want to see in a trend is we want to see this kind of stuff, right? Making lows and highs and lows and so on, right? When we get too much of this kind of stuff, that's unsustainable, and no market can stay in a movement like that. And so what we're trying to find is that confluence of indicators, levels, and trends. Where is something going to run out of steam and start to give us a new trend? So I'm actually not a reversal trader. I'm a new trend trader. I want to get in on the first part of the movement. I want to ride that thing as long as I can. So this right here is telling us this is an out of balance market. Here's a pivot point that's missed. There's a weekly pivot point that's missed. There's another pivot point. And there's a monthly pivot point, and a weekly, and a daily, and a daily. So all these circles represent upper targets that are missed. We don't really have any circles down below, right? So as this, you can see that we're sitting here at 68.60, right? The Australian dollar is coming right down to that. If I scoot this up just a little bit, you can see there's that big level from the weekly chart, right? This is our multi-year support. So as we're running it down into that, and we have all these targets and all these levels up above, this is starting to tell us that as we reach the decision point, the likelihood of this coming off that level and running back up towards those targets is very high. And we want to go with the very high stuff, right? the very high probability levels. So again, pivot points are crucial. I use pivots, I use daily, weekly, and monthly pivot points. Those are must-haves for me, right? If I don't have pivot points, I don't know what's going on. So I use daily, weekly, and monthly pivot points, which are the purple, the green, and the blue, right? The more pivot points I get adding up on one side or the other of the market, the more I know that I need to start looking for strong, big levels on long time frames and opportunities for the market to end its trend, its current trend, and start making moves towards those pivot points, starting to rebalance itself. And that's kind of what this Australian dollar is representing here. Is that making sense so far? Are you guys with me? We have this movement down to a strong level. We get to that strong level. There's a decision point. At that decision point, we make the decision ahead of time of, will the market run to a whole bunch of targets, or will it continue running to no targets? And 99 times out of 100, it's going to run to a whole bunch of targets, not to no targets. Does that make sense? Are you guys with me so far? Is everything coming through okay? So far, so good? Yes, yes. Okay, good. Hey, Jane, nice to see you. Good, good. Okay, guys. Don't hesitate. Ask questions. We're here for clarity. It's all fine and good. Okay, so we have that now. Here's one of my little secret weapons that I love, love, love. Pivot points, everybody can get pivot points. Any chart, any indicator, pivot points are all there, right? So you know, if you need help getting pivot points on your trading view, anything, I'm happy to help. On trading view, you just go right up here to your indicators and you type in pivot and you use pivot points standard, right? That's it. It's on there, it's free, it's available. I customize mine a little bit with colors and some different things there, but I'm just using pivot points, so they're available to everybody. But this is how they work. So the next thing, let's see, Eric, why the market has to retrace to touch pivot points. Eric, because of that rebalancing effort, right? Again, so as we mentioned, markets cannot run up forever or down forever, because that makes an out of balance market, and that is unsustainable, right? And again, the whole financial system would crash if everything just went up forever or down forever. We can have long-term trends, but those long-term trends have to take big, deep breaths, right? And so pivot points represent that rebalancing. Otherwise, again, things would just fall apart. Not just the Aussie dollar trade, but the entire financial system would not survive unsustainable movements like that. So it's just, again, representing a point of rebalancing. Here's my little my little secret weapon here, and I call these market imbalances, right? And those that are in my trade group, you guys are very familiar with these, and you know that they are the best thing since sliced bread. But a market imbalance is very similar to a pivot point, right? It's very, very similar to a pivot point, and basically what it is and what it means is that that we get very aggressive short-term movements that are not rebalanced, right? So when you get a big candle like this Australian dollar had right here, get a big candle like that, what we do is we look at the little consolidation to the left of that big candle, and these become such high-value targets. You can see that this market imbalance right here is overlapping a missed monthly pivot point. So that's a missed monthly pivot. And the fact that it's overlapped with a market imbalance here is super awesome, because now this becomes something that is, basically 101% likely to get hit very soon, right? And again, it's a strong candle. We look at the consolidation to the left and we mark that. And the market will either run through that and come back and rebalance that immediately, or it will continue running away, leaving other imbalanced areas, market imbalances and missed pivot points. And that just adds to our case that the decision point will hold and that the market will start to move back towards these levels. So market imbalances and pivot points are absolutely crucial for us to make a decision of what we think the market's going to do at the decision point, whether the trend is going to continue or whether it is time to look for the next direction in the market. Does that make sense? Everyone good with that? So if no pivots and imbalances, trend can continue. If no, it's good. That's a very good point, Norbert. If there's no trends and there's no imbalances, then it doesn't meet my criteria, right? And the trend might continue, it might not continue, but I don't know at that point. It can continue, but I don't have any kind of reasonable criteria there to tell me, yes, this is going to continue or this won't continue. And so I just will stay away from that trade, right? So very good point, very good point. We don't have targets for the market to move to, then at that point, yeah, then we just stay away from it, right? So again, this is a, this stuff that we're talking about here is a pretty three-legged stool here, and it won't stand one without the other. A trend on its own is kind of interesting. There's stuff that can be done there, but it's not enough. Or excuse me, targets on their own. Trend, levels, we've got to have all these things. Markets will always come back and hit targets. If we just say, hey, the Aussie dollar is headed down and there's targets up above, so I'm going to start buying the Aussie dollar. Well, that might be okay, but what if the big determining level is 500 pips down, is 1,000 pips down? Then yes, the market's going to come back to this target, but we might have to withstand 1,000 pips of drawdown before it does, right? Trend can help us kind of narrow that down a little more quickly. Sometimes we have sideways markets and we can be a little more aggressive about our targets and levels. Sometimes we have strong trends and we have to be a little more conservative about our targets and levels. So this is absolutely a three-prong approach, and without one, none work, right? So we've definitely got to make sure that we've got those in line. We've got our targets, which are the foundation of so much of what we do, but we've also got to have that trend in mind, and we've got to have that those strong levels. Now, there's other things that we can do. Those of you that are familiar with my scanner course and so on, I will use things like the 200 moving average to start timing my entries, right? If something's running down to a big level, the Aussie dollar is running down to this big level, and I'm saying, okay, there's targets up above, this is a really strong level, but I'm still not sure. Well, if I can find some good bar counts on a 200 moving average here, meaning that this thing has, become very extended away from the moving averages as well, that can be one more tool to help me time my entry. I use the 200 moving average as more of a timing situation. And so that's kind of one more thing that I use. I have a lot of statistics and a lot of numbers about how often things should be hitting moving averages, right? And you can see, on these kind of lower time frames, 30-minute charts, 1-hour charts, we're starting to get, kind of a long period that the market has not touched that 200 moving average. And so that also helps me with timing. So my strategy is find that trend, find those levels, find those targets, and then I'll look at that 200 moving average to kind of, again, help that entry get as precise as possible. Let me show you guys in kind of relation to those targets, in relation to those trades. In the group, we had a dollar Swiss franc trade that was kind of a pain in the butt because we had to sit in it for a long time because the dollar Swiss franc got stuck, right? It just did this, and we sat for like 2 weeks waiting for this thing to move. We were short, we were selling the dollar Swiss franc, and then it finally started to make this big move here, right? So, our highest entry was 10200, so we were in up here, and we got out down here. We had multiple entries on this, but we got out down here at 10055, right? Now, how did we get in so high to this movement, and how did we get out so low to this movement? And how are we getting big chunks of that? A lot of people will say, get the middle chunk of a movement. Agreed, middle chunks are good. What we like to try to do is get that kind of a middle chunk of a movement, right? We want to really take advantage of as much movement as possible. And we were in this dollar Swiss franc again. Our highest entry, we had scaled in. We were in multiple positions, but our highest entry was over here at 10200. And this thing went down. And why did we get out of it, right? Why did we take profit down here at 100? 5.5, which was and has been the bottom of this movement right here. Well, it was because this movement was coming down and we were starting to leave a lot of missed targets. Here is a, whoops, there we go. Here is a market imbalance, right? Dollar Swiss franc. We had strong movement, no pullback, market imbalance. We have a missed daily pivot, a missed weekly pivot, a missed daily pivot, and we had a third missed daily pivot. Whenever I see 3 consecutive missed daily pivots, I start getting pretty cautious about taking profit at whatever trade I'm in or looking for a new trend to happen, right? And in this case, we were already short, and so I said, okay, well, we've got missed pivots galore, and we even had a bar count, right? Meaning that, you know, this thing had not touched the moving average for a while, and we had all these upper targets lining up. So even though we weren't really coming to any kind of super major support level, there's nothing really super interesting happening down here, right? But I didn't need that because we were already in it. We were already in some great profit, and we had a high bar count, and we had all these targets up above. And that told us, you know, as much as that tells us that it's time to start trading in a new direction, it also tells us it's time to take profit for the direction that we're trading in, right? Does that make sense, guys? Are you with me on that? So that's how we got out of this, because our upper targets started to line up like crazy. Started to line up like bananas and go and get really heavy. And so, so our downward movement kind of couldn't continue on. And so we were able to get out and take literally 90% of this whole movement right here by understanding how targets work and understanding, you know, the trends and our levels and so on. Okay. So does that make sense? That's a lot of stuff, and I hope I haven't overwhelmed you guys with too much information, but this is how we are going to incorporate targets, trends, levels. You guys with me on that? Is that coming through okay? I never know if this sounds like total gibberish or if it's actually kind of clicking, right? I look at these charts so much and I just think, look, guys, look, it's fine, right? But I realize not everyone sees things the way I see things. So I want to make sure I'm explaining it well. Okay, good, good. As long as it's logical, makes sense, everyone can follow, that's what we want. Thanks, guys. Excellent. Okay, very good. So targets, trends, levels. This is our strategy. This is my strategy, right? This is what I have had to derive so that I can stay on track with these trades. Okay, and I do this over and over again. But again, it's got to come from knowing what the absolute big picture of whatever we're trying to do is. We've got to make sure that we have those 3 things and then we know that big picture, right? Must, 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 must. Okay, I think I've pounded that home. Does anybody have any questions before we move on to the next part? Pairs I avoid, that's a good question, George, and I'll have more information on that as we go, but definitely ultra high volatility pairs that are unruly. For me, I don't have good experiences with the Euro New Zealand, so I avoid that. I don't make money on the Euro New Zealand, so I don't trade it, right? We're talking about real results here, and I don't get real results from the Euro New Zealand, so I don't trade it. Other ultra high volatility pairs, I don't trade a lot of the crazy exotics because they're sometimes a bit difficult. You know, the dollar Turkish lira that had a massive crash, the dollar Russian ruble, right? Some of these ones can be very, very difficult to trade. I'm pretty extra cautious with yen pairs because those can be difficult sometimes. So ultra high volatility pairs, you know, pound New Zealand, Euro New Zealand, that kind of stuff, I tend to be a little extra careful on those high volatility pairs. And I try to go a little bit more for the lower volatility pairs. Most things that don't have the pound in them and some euro things in them can be pretty relaxed, right? Low volatility, and they tend to work fairly steadily, right? Euro Swiss, Euro dollar, Aussie Swiss, New Zealand Swiss, Aussie CAD, New Zealand CAD, you know, these kinds of pairs can be much lower volatility and they can get us into less trouble and just work more consistently for us. So I kind of like the lower volatility more than the crazy higher volatility ones. Okay, let's talk about trade size real quick here. Now, this is always kind of a topic of you know, that we really pound on in the trade group, right? And I want to spend a couple minutes on this for everybody, because this will save your life in trading. Trade size is everything. Everybody trades too big. Everybody starts off trading too big. That's just what happens. You just start off trading too big, and there's kind of no way around that, right? So that being the case, to keep our trading psychology good, we must reduce our trade size. Just whatever you're doing, whatever your trade size is, and this is excluding people in the trade group, right? Because I pound on you guys every single day about this. But for those of you that are not in the trade group, that are, you know, kind of up and down and all around on your trading, reduce your trade size. If you ever find that you get into a trade and you're stressed, it is 90% one reason, and it's because your trade size is too large. It's, you know, also other reasons, because your strategy, you may not be confident in your strategy, and you may not even have a total strategy, right? And so you get into a trade and you're thinking, geez, I'm in too big. I don't really know what my strategy is. I don't really know what's going on here. I'm throwing my money in the wind, and that's not good. So trade size is so important. That's such a huge element of successfully trading. Now, the smaller your account is, you can take a little bit more risk on smaller accounts percentage-wise than you do on larger accounts, right? When I trade a smaller account, I'll risk up to 5% of a loss on a single trade. But that's it. I will never, never, never let a trade go more than 5% in drawdown. And that's a series of trades, right? If I've put multiple positions on the Aussie dollar, for example, my worst case scenario is a 5% loss on a small account. Now, I don't trade a small account, so on a larger account, my maximum loss is right around 2%. I won't ever risk more than 2% of a loss on an account. Something I can come back from very easily. It's something that will keep me in the market. Yesterday, we talked about survivability. If we can't survive the market, we can't ever learn how to hone in our strategy and make this all work for us. So 2% is what I would recommend everybody with larger accounts stay with. If you have a smaller account, you can push it up to 5%, but that's our maximum loss, right? That's number one. Number two, every trade's a little bit different, so we have to have dynamic trade sizing. Some trades we're going to say, hey, if this thing doesn't work by this point, I'm out, right? I'm out of this. I'm looking for a shorter term trade. If it doesn't work by this point, I'm out. And so I'm going to have a larger trade size. If this doesn't work by this point, a longer term, I'm going to be out, but it's a longer term trade, so I'm going to have a smaller trade size. So every trade is different. Every currency pair is different. If I find a perfectly excellent, fantastic, wonderful, I can't pass on setup on a pair that I know is pretty high volatility, I'm going to be trading a smaller trade size. If that exact same setup is on a currency pair that's low volatility, I'm going to be trading a larger trade size, right? Let's just take, for example, the Canadian dollar Swiss franc, right? It's kind of a range-bound mover. It doesn't make huge trends up or huge trends down. But when I find a really good, rock-solid setup on the CAD Swiss, I love it. I'll take it, and I know it's going to work for me. But I'm also going to use a larger trade size because the CAD Swiss is not very volatile. It doesn't really go nuts like that, so I can probably take a larger trade size because it's moving a little less, and I want to make, you know, a little bit more money, right? And so, so I'm going to go with a slightly larger trade size. If I see that exact same setup on the Euro CAD, which is a super high volatility currency pair, right? And actually runs pretty opposite of the CAD Swiss. I see that same setup on the Euro CAD, and I say, this is perfect. This is a high volatility pair, but it's literally a perfect setup. It meets my criteria 100%. I'm going to trade it much smaller because I know that that's a risky pair, and it's you know, it's going to move more. I'm going to make more pips, but I'm going to take more risk from that extra movement, so I need to reduce my trade size. And then one of the most important elements here, hands down the most important element, is scaling in. Scaling in. Guys, we are never going to put our full trade size on to start. We're never going to do that. If you're doing that, please stop. please stop. And I'm only saying that because it will benefit you in a major way. If you're doing that, you've got to stop doing that because we're taking on all the risk right at the beginning, right? So why are we going to put all the money on at the riskiest time? We don't want to do that. Look at this. Look at this dollar Swiss franc, for example. And here's the reality of trading, right? We've got to give markets movement. We traded this dollar Swiss franc, right? And it was a movement like this. I had good reasons to get in, and I liked the trade, and I liked the setup and so on. My first entry was actually at 10075, right? I sold it right over here, 10075. There we go. Right through here. That was my first entry. I had good reasons to be getting in. We had some good targets. This isn't one that typically runs away from targets. We were coming up against some support levels. We were just at, just above that parity level, so on and so on. So I got into this. But that was my smallest trade size. That was my smallest trade size. I added another position at 101.50, right? This is a larger trade size. So trade number one. This is my test the water trade. This is my smallest trade size right here. Trade number two, this is a larger trade size. And then as this thing jumped around and hopped around over here, we took trade number three, which was our largest trade size, right? So if this continued to just kind of go against me and this, we had all this support here and this thing just wasn't going to have it, my largest trade size was going to, the loss of my largest trade size was going to be the fewest pips, right? If this thing kept breaking up and I just said, forget it, I'm getting out of this trade, it can't hold on to this resistance and it's moving up and I've got 3 open positions and I got to get out of this thing. My largest trade size is going to take the least amount of loss. My next trade size is going to take a little bit more loss. And the one that takes the most loss is going to be my smallest trade size. This right here could be a loss of literally a couple of Starbucks, as they say, right? So we're always scaling in our positions. We're always starting small and adding to it. A lot of people I see will do kind of the opposite, right? And people will tell me this. Okay, so position one is actually the biggest. Position two is the next biggest. By the time it gets up here, I'm so panicked, all I can put on is a little tiny amount. But I got to get into the trade, right? And that's upside down, that's backwards. So we've got to make sure that our first trade is the smallest, our next trade is a little bigger, and our last trade is the largest. That's how it has to be done. Does everybody understand that? Is everybody good with that? Does that make sense? We have to give the market room to breathe. We have to give it room to breathe, and in so doing, we have got to spread that risk out over a certain space, over a certain area. Super important, super duper important. Okay, Paul, is a $10,000 account small or large? Paul, a $10,000 account, I would call it medium. I would call it a medium size account. And on something like that, you probably want to start being in the lower percentages. If you're trading a $2,000 or $3,000 account, go for 5% risk on a series of trades, right? If you're at 10% or $10,000, start bringing that down to kind of the 3 to 4%, right? And anything above that, stay in that 2%. If you have a really large account, you're trading a few $100,000 or $1 million, 1% is even better, right? So you're kind of right in that area there. Dwayne, where am I with the Aussie dollar? Where am I in what way? In what way? Where am I with that? Mohammed, so we increase our size after we confirm the trend will continue. Yes, Mohammed. So we increase our size as the market continues to confirm, right? Because markets will start to invalidate. So as this, one thing that happens, right, is the more targets we have, the more confidence we can have that something is going to work, right? So this dollar Swiss franc, wasn't worried here, feeling okay here, and then starting to look for opportunities to add to this. But at a certain point, I'm starting to tell myself, okay, well, I've got a lot of targets, and markets always come back to targets. So I'm probably going to just stay in the trade and keep my risk manageable. Now, it's because I've honed in my strategy, right? And so I know that there's kind of a 200 pip window, right? This trade went from 10075 to up here about 102.25 or so. So we had a little bit of drawdown, right? But then we were able to take, over 200 pips profit on the trade, and it was, and it worked out great, right? So it's all about understanding how the market reacts with your strategy. And with my strategy, I hang on to these trades because I get into the high probability setups, I start small, and I add as the probabilities continue to go and grow, right? Does that make sense? So the more missed pivots we have and the further this gets away from the missed pivots, the more likely we are for that turn to happen and for that move to start to happen. But we always have to keep our risk in mind, right? We're never going to say, hey, this is going to turn around. I'm 20% down, but this is going to turn around. Then we're hoping, and then we're just in a death cycle, a spiral at that point. Dwayne, yeah, Aussie dollar, I'm still at 1. Still at 1 on Aussie dollar. Yep, still at 1. So start small, looking for 2. Well, it's a good question you ask, Eric. And with this trade size and scaling in, that is the question, right? This, by the way, is supposed to be Shakespeare. I didn't know he had an earring. Can anyone confirm whether Shakespeare had an earring or not? I don't know. Anyway, there was some funny Shakespeare pictures on the internet, by the way. You guys should Google funny Shakespeare memes because there's some good ones out there. So stop loss or no stop loss, that is the question, right? Do we use a stop loss? Do we not use a stop loss? I look at it this way a little bit. My good buddy Warren Buffett, all right, I've never met him and he doesn't know who I am. He said, wide diversification only requires investors when investors do not understand what they are doing, right? They don't understand what they're doing. I look at stop losses the same way. Stop losses are usually a safety net for people that are still trying to learn what they're doing, right? There are trades where I use a stop loss, where I say I understand the risk of this trade. I understand that if this doesn't happen, there's, certain currency pairs have certain volatility and characteristics of volatility. And so I say, this one's a super volatile pair. It's a great setup, but I'm not willing to take a chance, an extra chance on this. And so I'll use a stop loss. That is 10% of the time. 90% of the time, I do not use a stop loss because I understand my strategy and I understand my risk, and my risk is low enough that I will never get into trouble. Now, you might be thinking to yourself, well, what about a flash crash? What about the Swiss franc doing what it did? Or what about some of these flash crashes that have happened? It's a good point, and a stop loss will not protect you from a flash crash. So a stop loss is really more of peace of mind for people that are still trying to figure out if their strategy works, right? And if they are confident in their strategy. I have the utmost confidence in my strategy, and I know that I don't need to not that I don't need a stop loss, but I know that the market doesn't really work with stop losses. Keep in mind, guys, this is the kind of market we're dealing with, right? It's a massive market, and it has huge moves, and it needs a lot of room to wiggle around, right? And so if we have a stop loss and we're letting things kind of run and wiggle and do all of that, then we're kind of asking for it at that point, right? If I hear so often people will say, okay, I got into this dollar Swiss franc with you, and maybe I got stopped out, right? I say, well, why'd you get stopped out? Oh, because I had a stop loss. Well, why'd you have a stop loss? Because I didn't want to risk too much of my account. Well, why didn't you want to risk too much of your account? Well, because I started too big on the trade. And you can kind of see how the logic unfolds there. Trading without a stop loss is 100% reckless if you don't have a solid strategy and you don't know what you're doing. Now, if you don't have a solid strategy and you don't know what you're doing and you're trading with a stop loss, that is also 100% reckless, and you shouldn't be trading at all, right? We need to have a strategy. We need to know what we're doing. And when we do, stop losses will have a place in our strategy, but and it all comes down to your strategy, right? If yours depends on using a stop loss, then use a dang stop loss. My strategy does not depend on a stop loss. My strategy depends on bigger movements, spreading my risk out, and making sure that I give the market plenty of room to breathe. It's a huge market, guys. It's pretty, and I don't mean this in any kind of offensive way, it's pretty presumptuous of any of us to think that in a multi-trillion-dollar market that we are even going to be, that there's going to be any amount of hope that we're going to get into a trade within a handful of pips, right? I'm going to be able to get into this entry and it's not going to go more than 25 pips against me. That's when I always hear, I had a 25 pip stop loss, 30 pip stop loss, 50 pip stop loss. It just feels ridiculous. It feels ridiculous to me, and hopefully I'm not offending anybody, but it's a little bit ridiculous because we're in this huge market, and for us to think that we can nail an entry within a handful of pips is insanity, right? So that's where we've got to have a strategy, and we have to respect a market that's huge. It's kind of like trying to cross the ocean in a on a boogie board, right? You're probably not going to make it. And in a huge moving, highly volume heavy market like the foreign exchange market, we're not getting entries. We're not nailing entries within a handful of pips. Maybe you've done it. Maybe you're doing it semi-regularly. That strategy and that method will always burn out. I've never seen it. I've never seen it work long-term for anybody. I've never seen it work long-term for anybody. And I've been working with traders for over a decade. I've been trading for a long time, but I've been specifically working closely with traders for over a decade. And I've just never seen anybody have a sustainable movement, a sustainable career using tight stop losses. Just doesn't work. It doesn't work. Paul, if the turnaround happens on trade number 1, when do you add trade number 2 and 3? Paul, that's a good question. And that is part of the risk that we take, right? There are ways to add, and I'll talk a little bit more about that. But part of the risk that we take, and it's not a bad risk, it's a limited upside risk, is if we scale into a position and the trade just immediately works for us, then we make less money. We still make money, and anytime you make 1 penny in the market, you're a step ahead, and that's what we want. But when I scale into a position, if this dollar Swiss franc would have gone like this, oops, if it would have gone like this, I got in right here, and if it would have gone like that, I would have been bummed out, right? I would have been kind of sad because I would have made money, but I would have made a whole lot less money than I made on this movement right here. But guess what? Do you see how this changes our mentality in trading? Instead of getting into a trade and going, please, 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 please work. You've got to work. Come on, work. I need this to work. Now I'm getting into a trade saying, please, please, please go against me. Go against me just a little bit more. I need to put in a bigger position. And then I put in my bigger position. I go, okay, come on, just go against me just a little bit more. I know you can go against me just a little bit more. And then it does, and I put on my bigger position. And then I sit back and let the trade work, right? Now, there is, to kind of talk about that for just a second, there is just the simple point of view of if this happens and it runs right for me, right? It just goes my direction, and I say, well, all right, I made some money on it. I didn't make a lot of money on it, but I made some money on it. If this takes several hours or a day or two to play out and start running towards, one of the lower targets that I was aiming for in the first place anyway, and it starts to kind of slowly get there, and along the way, it has some sort of setup where I say, hey, I'm already in this trade and I'm up 15 pips, but it's giving me another setup that if I weren't already in this trade, I'd be getting in right now. So even though I have this trade back here, 15 pips in profit, and this has been consolidating for the last 2 days, and it's starting to break that support, and I'm saying, geez, if I weren't already in this trade, I'd be getting in right here. Well, that might be a good point to add a second position. Little, small, conservative scale in profit and let it run to that target. So there still are ways to get additional positions when a trade doesn't run against us. And I don't do it as often. I definitely always scale in and draw down, but I don't really scale into trades as often in profit, but you can. If the setup is something that you say, I would get into this if I weren't already in it, great, put another trade on, go for it. So good. All right. I love it. Yeah, Paul. This is a good way to look at the market. It takes a lot of stress out, and that's why we're having this webinar about trading psychology and strategies. Right? You've got to have a strategy. And you've got to take the stress out of trading. Trading is not a stressful thing. It doesn't have to be stressful. I'm not ever stressed out trading, ever, because I abide by these principles. James, yeah, it's refreshing to hear that about stops. People say stops because, as our good buddy Warren Buffett says, they're less confident in what they're doing. So we've got to spread ourselves out in the market. That's why when you cross the ocean, you do it in a huge boat. You don't do it in a rowboat, because we have to have the right point of view and the right tools and the right mentality for the conditions. Mohammed, does that mean that you always assume the trend will come back to a previous predicted direction? I mean, Mohammed, yeah. So when I get into a trade, I don't ever try to assume anything. I just trust my system, right? I trust my strategy, and it's worked for me. I hate to go back to this so many times, but it's worked for me so much for so long that I don't really question it anymore, right? It just works for me and for people in my trade group. And so I no longer think, oh, is this going to work? Now, there are points where I say, okay, this trade it's just not doing what I need it to do. But again, that's pretty rare, because the further the market runs away from targets and the further it runs away from, and gets overextended, the more likely it is to turn around. And so I just will wait longer to add to my position. I'll be, with my strategy, I'll give you guys the details here. I take my first position, and I expect the market to go against me 200 pips. I always try to get in at the best point possible, but I always leave 200 pips from that first position before I start getting concerned, right? Before I start saying, do I need to be thinking about this? And oftentimes I'll scale in, depending on how the setup is, depending on how volatile something is, I'll my first and second entry could be 50 pips apart. They could be 200 pips apart. But it just depends on how much of a mover something is and kind of what's happening. But I always give myself at least 200 pips of movement, because this is a big market, and for us to think that we're going to get that perfect spot again is not realistic. It's not reality. Now, we were able to get out of this thing perfectly. We got out of it perfectly, but if I were to get into this, I would say, okay, I'm going to get in right here, but this might just be continuing to run down, so I'm going to scale in, and so on and so on, right? Have you sometimes put on a fourth position, Eric? Yeah. I've had trades where I've had 5 positions. Yeah. But I'm always keeping in mind, whenever I add a position and wherever I add a position, it is always in line with my risk management. If I'm in a volatile currency pair and I say, okay, I'm going to start scaling into this thing, and as I scale into it, I have a, it's a volatile currency pair, for example, and I know that it has a higher probability of moving. My first 2 positions might be very, very small, right? I might not start to put much meat on my trade until maybe my 3rd and even 4th position, right? Because of it's a higher volatility currency pair, for example. The dollar Swiss, unless the Swiss National Bank surprises us with horrendousness like they've done before, the dollar Swiss franc is not a volatile pair, so my scale-ins are much closer together, right? So it just depends on kind of that currency pair. It's all about key levels. Yep. So I give myself, 200 pips. Mohammed is kind of a general area, right? But it's all about, I add positions as setups merit adding positions, right? So it's not just, I don't say I'm adding every 50 pips. I'm adding every 75 pips. I'm adding when I reach another level, right? When I get to another major support level or a major resistance level, then I'm adding positions. So the one thing I want everyone to kind of get away from a little bit is trading has to be very, very formula based. It does, we do need a formula, we need a strategy, but but a lot of people do want to say, okay, how many pips should my stop loss always be in? How far apart should I put my positions and so on? It's not like that. We put our positions on as the market tells us that we're to the next level, right? And we see, we know in advance where those levels are. We plan that all out in beforehand. Again, if the currency pair is more volatile, I'm starting off smaller. If it's less volatile, I'm starting off with larger position sizes. I'm just being very dynamic with my trade sizing and positioning depending on the currency pair. Because again, I know the characteristics of these currency pairs and how they behave with my strategy. Make sense? Everyone good? Yeah? So, so that is that's kind of how we want to approach this stuff. That's really how we want to approach this stuff. So as we go back over here again, it's a big wild market. Let's give it room to wiggle, and let's be patient. Let's let that happen. And that was one of the other elements that we talked about going back here, which is we have to have a strategy. We've talked about the strategy. We've talked about the trade size, right? And one last thing I want to say about a trade size, if you have a $25,000 account, let's just say $25,000 account, I want to officially give everybody permission to trade as small as they want. If you have a $50,000 account, a $100,000 account, and you take your first trade size at $1 a pip, that's okay. There is no requirement, there is no law in Forex trading that says, hey, Mohammed, hey, Eric, hey, Paul, Dwayne, you have to trade this large of a trade size for your first position. And it has to be this big for the next position. Everybody that pushes trade size, like on the bigger side, like go bigger, you're not going to make any money. You will always get in trouble that way. So I give you permission to trade as small as you want on that first position. Now, sometimes we need to build confidence and sometimes we need to build our skill set, and that will naturally increase our trade size because we'll start to have a better idea of what we're doing and so on, but never feel like I'm wasting my time because I'm taking too small of a trade size. That first trade size could be 10 cents a pip if you want. The next trade size, as we have a little more confidence in the setup and in the currency pair that we're trading, the next trade size can be 50 cents a pip, or it could be $5 a pip. And that next trade size could be $6 a pip, or it could be $50 a pip, right? It's just what fits into your account size and what are you comfortable with. So never feel like there's a minimum amount that I've got to do. There's never a minimum. There definitely is a maximum, though. There's absolutely a maximum. So you had shorted this pair. I'm not understanding why the pair going up, you are losing value. Patty, on the dollar Swiss franc, you're saying, yeah. So we were shorting it. We were trading it to go down, and it was going up. So it was going the wrong direction. Well, not the wrong direction. It was just continuing to go up when we were placing a downward bet, right? And so so then we add more and we add more so that by the time it does go down, we've got multiple positions that are making money on the downward movement. So yep, good point. Lester, any idea on the appropriate margin level percentages we should maintain? Lester, darn it, I'm so glad you asked that because I tell people on your MetaTrader, you'll have margin percentage, right? And it'll always be these crazy numbers. You'll see numbers like 1900%, right? Does everybody know what I'm talking about? 2000%, 800%. I always wonder how these percentages come about. They're always kind of funny. But you'll see these crazy high percentages, right? The margin level percentage that I recommend everybody maintain is 1,000%. 1,000%. At the bottom of your MetaTrader, you'll see a margin level percentage and just make sure that that's at 1,000% when you're in a trade. As it gets below 1,000%, you're still okay, but you're starting to get to a point where you're pushing your account boundaries a little bit. So MetaTrader, margin percentage. You'll just go down to your trade area down there, and you'll see percentage, and just make sure that that stays, you know, at or above 1,000%. If it gets down to 800 or 900%, it's not the end of the world, but you're starting to kind of put the limits. You're pushing the limits a little bit there. Good, great question, Lester. Thanks for asking that. That's awesome. Mine is 5,000+%. By the way, took my first 15-minute trade. Okay, James, good, excellent, excellent, very good, very good. Yeah, 5,000% is even better. So, you know, we're gonna have to drive that percentage down a little bit because you know, we're gonna use up some of it, but yeah, keeping that percentage high is good, and that guarantees our survivability and it keeps us out of trouble. Okay, guys, so just a reminder, as we talked about yesterday, remember, busy versus productive. Sitting and being patient in a trade is so important, so important. And the more that we are trying to do, the more trouble we typically get ourselves into. People think, hey, I'm a trader, I should be here at my charts 9 to 5 because that's what society has taught me that I need to do. I need to spend 8 or 9 hours doing whatever I'm doing. And so if I'm here, I better be trading. Those are all wrong things, right? And it brings me back to an argument I had with a friend one time where I said, I'm sorry your opinion is wrong. Just such great irony. But it's wrong to think that to be a successful trader, we need to spend 8 hours a day in front of the charts, because we don't. We don't. I have made some of my best trades by putting them on and letting them play out and spending 15 minutes in front of the charts. Yeah, exactly, Dwayne. Take a position, dang it, and go fishing, go on a walk, go spend time with your family, go do anything, right? We don't have to be busy all the time. But that's what our society teaches us, right? I mean, those of you that work a job that you have to show up to an office, I mean, if you really dig down and go through all this stuff, in the 8 or 9 hours that you're at your office, how many hours of work do you get done? Some of you might get 6 or 7 hours of work done, and that's awesome. And some of you might get 1 or 2 hours of work done in an 8-hour day. Trading, you can't push a rope, right? Trading is, there's a setup, we take it, we let it play out. If there's no setup, we don't take it. So this feeling of we must be busy to be productive is incorrect, because we're either busy or we're productive. They're actually two very, very different things. And in trading, the more we push it, the more trouble we get ourselves into. And it doesn't ever turn out well. In fact, it turns out horrible most of the time. So patience, remember, busy versus productive. Stop trading to trade. Some people just say, I'm here, I'm trying this trade out. I look at people's accounts all the time and I say, why did you do this trade? I don't know, I was just giving it a shot. Just giving it a try. I don't know. That doesn't work. That will kill you in trading. Can't do it. So stop trading to trade. Number 2, stick to your plan. We've talked about that criteria that we only trade that criteria. People ask me sometimes, why do you wait for trades for so long? Because it doesn't meet my criteria. Maybe I should have 11 different criteria that I trade, but I don't. I have a few. And if, you know, I could approach the market in 1,000 different ways. I'm not saying that I have all the answers and that I know everything. There's a few things that I do that I like, that work well, that have been very profitable for me, and that's it. And so I don't need to get a trade out of every bit of movement that the market has, because that's stressful and that is risky, and that's where things get a little bit crazy, right? So stick to that plan, stick to that criteria. Remember, this is such a useful reminder in trading: quantity versus quality. We do not want to just take trades and hope that of our 50 trades that we did this week, you know, 35 of them were profitable, right? I don't want to do that, because I'm spending a lot of time backpedaling and trying to make up the losses on those, you know, on those 15 that didn't work, or those 20, or those 25 that didn't work. So we want to make sure that quantity versus quality is something kept in mind here. One thing that I love is, I think this is such an accurate description of large amounts of trading, right? Anybody know what the speed wobbles are? Anybody have an idea of the speed wobbles? This is what happens when we take a lot of trades, right? It gets very, very, it gets very hard to determine the outcome. It's like when you're riding down a big road on a skateboard, and you get going so fast, and your skateboard starts to get a little unstable, and yeah, you got to tighten up those trucks, and it gets a little unstable, and all of a sudden that instability, excuse me, is starting to go crazy, right? That instability is starting to tell us, this could go bad, and this could go bad quick, right? It's like getting in a car accident at 10 miles an hour versus getting in a car accident at 100 miles an hour. The outcome is a lot more volatile at higher speeds. And as we trade more, as we trade and trade and trade and trade and trade and trade, and we have 100 trades, we're trying to see, okay, I did 100 trades this week, I did 500 trades this week. How did it all come out? Well, was I profitable? Yes, maybe, I don't know. It's, what's going on here? Yeah, the death wobbles, yes. And so that whole situation is what happens when we trade too often. So we start to see these things, it starts to get very difficult to determine the outcome when we trade too often. And so let's trade good trades. Let's make sure they stay within our criteria and that we don't get the death wobbles, because the death wobbles, again, are good for nobody. They're just good for nobody. So keep any unprofitable ideas to yourself. That's right, Corey. I love it. Absolutely. Oh, 58 years old on a skateboard. There you go, George. Keep going, man. Keep going. Less is more, Norbert. You're absolutely right. Okay, guys. So just a real quick reminder of all this. Remember that what we expect versus what our results are, this is super important, and these are things that are part of this trading psychology. Again, I will have this recording, and I'll have the PowerPoint presentation for everybody to download. You need to know your statistics. Use your account history, right? A lot of times people say, I really love to trade the Euro New Zealand. I bring up the Euro New Zealand because it's my nemesis. I really love to trade the Euro New Zealand. I say, awesome, good for you. Look at all your Euro New Zealand trades, and they'll look at 50 Euro New Zealand trades, and overall they're down 200 pips. Then it shouldn't be your favorite pair to trade, right? Because the results are not what you expect. You're expecting that, hey, this is my favorite pair to trade and I make money on it. Actually, you don't. Actually, you're break even. Actually, you're 5 pips in profit. It's not. It's wasting your time and your energy, and you need to just go with what works, right? Find other currency pairs. I had a long time in my trading where I said, nah, why would I ever trade the Aussie Swiss? Why would I ever trade the New Zealand Swiss? Those are ridiculous pairs. And then years ago I said, those are kind of interesting. Maybe I'll trade them and see what's up. I make endless amounts of money on those currency pairs now, and it was just my own ignorance that kept me away from trading them, because I thought I was making money on other pairs. I used to love to trade the pound dollar and the euro dollar, and then I found out, guess what? I don't really super consistently make a lot of money on those pairs. So I'm not going to trade those as much, and I'm going to trade other ones that do make me more money. So find out what works and avoid your kryptonite. Find your kryptonite, go through your trades, and look at what you're consistently losing money at, and stop trading it. Just stop trading it. Be a surgeon, cut it out. It's cancer. Stop trading it. So those are important details right there. All right. Does anybody have any questiones about that stuff? That is questions, comments. What do you guys think? We're going to wrap this up in about 5 minutes here. So I have a few more quick things to talk about, but are you guys good with that? Is that making sense? Again, this is recorded, and you can download this presentation and look over it and kind of just internalize some of this material. I think it's really good stuff. So everything good so far? So good so far. Excellent. Okay, so Thanks, Marianne. Is this Marianne? Which Marianne is this? Good to see you, by the way. Good to see you. All right, Arkansas, Marianne. That's what I thought. That's what I thought. Very good to see you. So happy to see you. Norbert, I'll give you, thanks, James. Thank you. I'll give you the short answer on hedging. I've done a lot with it. It more often than not doesn't. More often than not, it does not work. So, thank you, Jim. Thank you. I really appreciate it. So hedging usually is a mixed results thing at best. If you guys remember, all Forex brokers, and now outside of the US, Forex brokers will allow hedging where you can just be long and short on a currency pair. Like I can buy the dollar Swiss franc and I can sell the dollar Swiss franc at the same time. And most brokers outside of the US still allow that, but brokers inside of the US stopped allowing that. And I was really mad when they stopped allowing that. I thought, that stinks. But they said, we just found that more often than not, it keeps people in trades and it never makes anybody any money. And I thought, well, first of all, give us that option at least. Thanks for taking away our right to choose. That was dirty. But at the same time, I thought, it's true. I never really made money hedging. It would take the sting out a little bit, but it usually got me caught in a trade that I could never really get out of with a profitable outcome. So I did have some automated trading that used hedging that was pretty cool, but for the most part, it was never really a good thing. So hedging is usually not good. More often than not, it's just not good. Thank you, Paul. I really appreciate it. Thank you. Thank you. Thank you, Patty. I've been staring at these charts for probably half of my life now, so I'm happy to share with you guys a couple of tricks that I've learned, and I'm glad you guys are here with us. Yes, Mark. Yep. And Mark, actually, excuse me, Marks. Let's talk about that for a moment. So remember, guys, my live trade group will help us focus on patience and strategy and proper trade sizing. So that's what we're here for. In my group, I obviously go into a lot more detail about the strategy. And again, you can see my trade history right here. It's good. It works. We make a lot of money. We make a lot of pips. It's all very awesome stuff. So that's what we do in the group, right? We have a strategy that works, and we're patient with it, and we make money time and time and time again. And so, I have 2 live webinars every week for the group where we learn and learn and learn. And it's super, super great for those that want to trade and want to have a long-term career in this business. We talk about how to properly position for every trade, right? Where do we think that this thing could potentially go? That's what we do in the group. And so we talk about properly positioning ourselves and making sure to keep our risk absolutely as manageable as possible. So that's what we do in the group as well. Trade size, trade size, trade size. And we're accountable to each other. So oftentimes in the group, we'll be talking about, hey, we're sitting waiting for something to set up and it's been 3 or 4 or 5 days and nothing's happened. Everyone's going, geez, should we be trading? And we say, no, because our criteria is not met. And it helps encourage people. It's kind of like being part of a support group here. It helps keep you out of the over trading business. It is so important to stay away from over trading. Must do. So again, what I offer is it's a yearly subscription to my group. And the reason I do a year is because I want people to commit to me like I'm committing to them. If you try something out for a month, you're just getting into the learning curve. You got to stick with something for a long period of time so that you can make it all work. And so I have a yearly subscription where we do over 100 live weekly webinars. We do a couple webinars every week. This is a $1,000 value at the very least, because there's so much learning that happens here. These webinars alone will make you a successful trader. On top of that, I have daily and weekly trade recommendations. Every day I update on our current trades. We add new trades. We update trades. We do everything we want there. And I give specific, precise entries and exits. That is a $2,500 value at the very least. This year alone, we're up 3,780 pips. Now, if you were trading $1 a pip, you would have made $3,780 just following my trades at $1 a pip. So that pays for something there. But specific trade recommendations is what we have. I throw in there a 1 hour one-on-one session with myself. I charge $500 an hour to do these, but I put these in with people that want to join the group because I want to make sure that everybody has a chance to talk to me and get up to speed with what we are doing in the group. So that is a huge help to get you really acclimated to our trading style and everything that's available to you to make sure you get the most out of it. So it's kind of an onboarding session, I call it. It's really, really good, really, really helpful. Connect our screens. We do exactly what we're doing right now, and it's awesome stuff. And it's one-on-one. Along with that, you get a chance to be very consistently profitable at trading for the rest of your trading career. You spend a year with me, and it will change your trading career. If this is something you plan on doing for the rest of your life or the rest of your working time, you cannot afford to not spend a year trading with me in this trade group. It's an absolute must. So the webinars, the one-on-one sessions, the daily trade recommendations, $4,000 value. I don't want to sound like a used car salesman, but it is open for the next 2 days for $999. This is what I charge for annual memberships. Sometimes I'll do a one-on-one session, sometimes I won't. There is open enrollment in these annual sessions about twice a year. Once or twice a year, I'll allow people into the trade group. That's it. If you go to my website right here, and you go to, that's me, that's the family with our heads cut off. If you go to, whoops, hold on here. There we go. If you go to my website and you say, okay, hey, this is great. Products, I'd love to learn more about your products. Oh, you have a live trading group? Here's your $999 group. Yeah, I'd love to learn more. It's going to take you right here. And what you can do is you can submit some questions, and I will look over those questions, and I'll put you on a fantastic waiting list. And you will be top of the list to join the group next time we have an open enrollment 6, 8, 10 months later. So I open these up very, very infrequently, and once or twice a year, you can join the live trade group and be an annual member. So this really, truly is, like I said, I'm not trying to be a used car salesman over here. This is how it works, and those of you that have attended these webinars know that I do not do these very frequently at all. So I'd love to have you guys join us. You have a great opportunity to learn some of the things that we've talked about and really internalize those and make them work for you. Sharon, very nice of you to say you've been with me since 2014 and hanging strong. That's awesome, Sharon, and it's been great having you with us. It's been super, super awesome. Thank you, Corey. Thank you. I've been great. No, I didn't pay you. Thank you, Bob. Thanks. I really appreciate it. Yes, Mohammed. Yep, in the group, we all go into the same trades and we all trade everything together. Every trade that we're in, I post in the website. I update every day. We're all 100% on the same page. Will, this has been opening my eyes and mind. Could you please send me the video link on how to begin and set up from beginning to end? I have bits and bits and I want to put it all together. Absolutely, Will. Yep, I will send you this. I will send you these recordings, and and again, guys, the best way to thank you, Jeff. Thank you. I really appreciate it. Thank you. Thanks, Norbert. I appreciate it. Yeah, awesome. Very, very good. And yeah, Mohammed, once again, all the groups all the trades in the group are very specifically entered and exited. They're not general areas. They're not, hey, try this area, try that area. It's buy here again, buy here again, exit here. Exactly. And so, if you go and look at, for example, the trade history on that dollar, this thing, I had a problem with the website, by the way. So we didn't actually make 225 pips on the dollar Swiss franc twice. It's just the website gave me an issue, but it'll always tell you exactly where we get in and where we get out. So yeah, it's very specific, very, very super specific. I'm looking for the bigger trades. Looking for the bigger trades, Mohammed. Absolutely. Thank you, Lester. Thank you. So, guys, again, you have till midnight tomorrow night to sign up for the trade group and join us. Again, if you would have traded $1 per pip on this whole thing, the membership would have paid for itself almost 4 times by now, and we're not even halfway through the year. So, so that is how this works. So we'd love to have you join the group. You've got another 24 hours or so to jump in on that. And go to this website right here, dtfx.co/trading success. Trading success. That's this guy right here. You can watch the webinar recording, but most of all, you can sign up for the trade group. And this will give you annual access and get you going here. And it'll show you all the things you get: daily trade alerts, weekly webinars, a one-on-one session. Sign up now. So trading success. So you've got till midnight tomorrow night. We'd love to have you join us. Really looking forward to working with all of you new people and having you guys join us in the trade group. I think it'll be a great experience for you. Thank you, everybody. Any final questions before we wrap it up? Yes, this is recorded. George? No, let's see. Who asked that? Sorry. Yes, yeah, it's recorded. Absolutely. Will, as you can see, I'm on an Apple computer right now, so I trade from a Mac, so it's not too terribly hard. Not too hard. I have a little VPS to run MetaTrader on for the things that I need, but I actually do all the analysis for my charts, and honestly, I execute a lot of trades from my phone or from a tablet, so it's pretty easy. But I do all the analysis on my Mac because I use TradingView. So, Mohammed, $9.99 is for the things that I just mentioned. So you get these guys right here, which is you get access to my trade group. You get my daily recommendations. You get my weekly webinars and so on. But it does not give access to all of my trading courses. I have trading courses, and I actually have another trade group here that is kind of just a specific strategy. But all of my trading courses, the scanner, the 15-minute scalping, all that is not included. This is the premium trade course, which is 2 webinars, daily trade recommendations, one-on-one session. So yes. Okay, guys, thank you so much. Thank you for being on. It's lovely to spend a little bit of time with you this beautiful Saturday morning. Appreciate your wonderful comments and your feedback and your input. All very good stuff. I very much look forward to having you guys in the trade group with us. And for those in attendance that are already in my trade group, we'll see you Monday morning for our live webinar. We have some great things to discuss. And I look forward to seeing all the new people that are going to join us this weekend for the next year of great, awesome, fantasticness. Really looking forward to it. Thanks, everybody. Nice to see you all. Have a great rest of your weekend. Looking forward to having you in the trade group. Take care, guys. We'll see ya.